Hi everyone, it's Alex here at Hedged Capital Research. Welcome to our Growth Investor Pro webinar. It's Thursday the 6th of April, 5 o'clock Eastern, as always, and we have a really special session today. We're going to do three topics. So the second two topics, you've heard them before, right? We'll run through the equity indices, we'll do the NASDAQ, the S&P, the Dow and the Russell. And then after that, we're going to talk about wood stocks being the high beta, high growth software stocks that many of whom continue to bump along their 2022 lows, and some of which look like great long opportunities with proximate stop placements. So a great risk reward setup, which even if wrong, oughtn't to hurt too much. However, before we do that, Jay Abane, who you'll be familiar with from the service, is going to walk us through the infamous JPM wrecking ball, which is the hedged equity fund that wrought havoc on the S&P all last year. Misunderstood by most. Jay, who does a fantastic job for us in the service with his options channel, and it should be emphasized that Jay comes at options from maths, which is the best way to come at it, is going to walk through what the hedged equity fund is and why it matters to know what they're doing, even if you have no interest in JP Morgan, no interest in hedged equity funds, no interest in options, but you are an investor in stocks because it does affect the S&P, and the S&P affects most things. Before we get on to that, let's do some of the boring stuff. So let's do our disclaimer. Okay, hang on. That was all right. Let's do our disclaimer, and then we'll hand over to Jay. Right, so disclaimer. This webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, nor should it be relied upon to make investment decisions. Hedged Capital Research, its employees, agents, or affiliates, including the presenters of this webinar, all related persons may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenters as of the webinar's date of transmission and are subject to change without notice. Companies referenced in this webinar or their employees or affiliates may be customers of Hedged Capital Research. Hedged Capital Research values both its independence and transparency and does not believe that this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, I'm going to hand over to Jay right now, who Jay, if you don't mind, if you could introduce yourself. We've got many new members here, and so just give you a bit of background on yourself and what you do in the service would be terrific. I'm going to make you the presenter right now.
There we go. Is that large enough, Alex?
Yeah, I can see that well.
Okay, great. Yeah, hi everyone. My name is Jay Urbane. I'm a, I would say, semi-retired computer science professor. I work on do a lot of grant work, kind of like very data science, machine learning kind of oriented stuff. And I'm interested in options. Okay, so I'm not a financial guru, so please correct me if I'm wrong on anything. But I find options to be very interesting. Okay, great. All set? Okay, so this kind of leads into some of the things I post on the options channel as well. But JP Morgan sells these hedged S&P funds. And the first one was called JHEQX. I always have trouble with that. But in any case, it has grown to have like 15 billion in assets under their management of that fund. So it's very large. And by hedged equity, what they're doing is it's an S&P fund, but they use an option overlay strategy to limit drawdown or downside risk. Okay, and so the fund got so large it affects the market. Okay, and part of what they started 2 additional funds. So basically, to protect the downside risk, they use an option strategy called a put spread collar, and they renew it every 3 months. Okay, so this is the main fund here. Original hedge equity fund. And so like this would be like January 1st, and this will be a 3-month a collar option they'll put on, and then it'll expire like March 31st. So this actually just expired last March 31st. Okay.
Jay, for those amongst us who don't know, could you explain what a collar is?
Yeah, I've got that. Okay, I'll add that in the next slide. Okay, but in any case,
great.
so basically they have these hedged equity funds. They use an option strategy to protect the downside risk at the cost of upside potential. And now they have these option strategies expire on a quarterly basis for each of these funds, and they're staggered by 1 month. But the first fund here, this blue fund, is by far the largest since it has 15 billion. So the calendar quarters have the biggest expirations for these option strategies. Okay, so you can kind of see what this is the fund performance. So I put Crampa crowd. So basically you're getting reduced return, but much lower volatility and a better Sharpe or a better risk-adjusted return, at least with respect to the Sharpe ratio. So most people they're willing to sacrifice that upside when they go into these funds to protect big drawdowns. Okay, great. Okay, so this is the option strategy that they basically use. It's called a put spread collar. So what this diagram shows is, if you look here, this is the price of the option here along the x-axis, and the green. Yeah, go ahead. I'm sorry.
Jay, could you zoom in on that, please?
Sure.
Perfect. Thank you.
Is that okay? Okay, good.
Yeah.
Yeah. So I looked it up. These are the actual strike prices they use to implement the strategy. Okay. So these are all for the June 2023 expiration. So what they're really interested here is in this put. Okay. As anybody that's tried to buy puts for downside protection, you find they're really expensive. Okay. So that put is right around here, right where you see this bend in the red line. So basically, if the stock price falls, it's not going to keep going down, right? It's going to be limited to this bar here, right? So so these are the strike prices, and then the y-axis is the profit and loss. So by buying a put, they're preventing it from falling any further. Now, to help pay for this put, since it's expensive, they sell a call option on their underlying position of the fund itself. So they call that a covered call. So they buy one put below the money. Okay, they sell a covered call above the money, out of the money, so to speak. And since the call doesn't quite cover the cost of the put, they also sell a far out of the money put as well. So that's this leg here. So this is the entire option strategy. So you short a covered call, you buy a long, and then you basically also sell another put further out of the money. Their logic being is, hey, it might fall 10, 20%, but it's not going to fall 30%. And I might as well collect some premium to help pay for the strategy. Okay, so that's basically how it works. And this is actually a good strategy. I've used this around earnings. So the problem with it is, if the stock goes up or skyrockets, it's going to limit your upside potential. But again, it's going to protect your downside. So it's kind of like you're mildly bullish, but kind of nervous. That's the kind of strategy it is. All right, cool. Okay, so this page has got a lot of text, but it kind of shows you how they would calculate it. So also feel free to ask questions or
as always, folks, if you have questions, just unmute yourself and shout. I'm sure Jay won't mind being interrupted.
No, I present better that way.
Okay, Jay, we've got a question from Nick Powell. Nick, do you want to speak up? Hang on, I'm going to unmute you, Nick. Hold on.
Hello?
Hey, you're on. Okay,
perfect. I was just wondering, and I probably know the answer to this question, but why don't they sell these options or roll them over on the secondary market? Is it just a liquidity issue? So why wait until expiration? Why not
Yeah,
smooth it out?
right. I think they do that to some extent. They don't tell people, but it's always really close to the expiration date.
Okay.
Yeah. So I've noticed, because I just became kind of curious. So what I'll do is I'll look at the option chain, and I've seen new options being placed before the expiration date, and then you'll see the index move around. So when these big option strategies expire, it's like helps let the SPX find where it should be priced at in the market a little more easily. It moves around a little more fluidly. But yeah, it's not always right on that date, but it's really close. It's really close.
Okay. Thank
At
you.
least that's what I've read, and that's what I've observed. Okay, so this is the why does this kind of happen? So this is the JPM hedging. So this is the hedging strategy that JPM uses. Okay, these are the call, the put, and the other put, and these are the delta. And so basically, the delta is basically tells you how much the price of an option changes with a 1 unit change in the underlying index or stock. Okay, so that means the market makers, the dealers that make the market for all these options, take the opposite side of that trade, right? So if JP Morgan sells short this covered call, that means the market maker is long that call. Okay, so they're long that call, and since market makers don't want to take a directional position, they use this delta hedging strategy, right? So they they use the delta basically to calculate how much they need to hedge. All right. So basically, if you look at the delta, so this is the delta here, 0.262, and basically, if you just take 0.262 of a $16 billion fund, you're going to come really close to $4 billion. Okay, so that means to hedge this position, that for the $16 billion fund, they have to sell short $4 billion worth of stock or the equivalent futures. So it's a big trade. But I actually worked out a little more detail, and it looks like I came up with the right answer. So this would be the delta. This would be the index strike or the nominal price for this call option, the number of shares per contract, and then the total number of contracts. But you get really close to that 4 billion, which is about 0.26 of 16 billion. Okay, so that's how this is how the option maker, a company like Citadel, would hedge this call option. Because call option, and then they also have to hedge the put, right? And since JP Morgan is long the put, that means the market maker is short the put, right? So it means they actually have to sell more stock to hedge the put. And then finally, the far out of the money put is smaller. So the market makers have to do a lot of hedging, right, to be able to make a market for this option strategy.
So I'm just going to interrupt here. The key point here was what happened in 2022 was that these funds alone had a reasonably material impact on the S&P sell-off through the year, because as they were hedging further and further down, as Joe said, the downward pressure on the index was amplified by the dealer hedging. And so as the year progressed, as they rolled out their puts to a further expiration date and a lower strike as the index fell, and you can see why they were doing that from Joe's diagrams, that alone had some impact on dragging. You had a sort of reflexivity curve where that alone dragged the index down somewhat. And so you get a kind of a feedback loop going on there, which is one of the reasons, it's obviously not the whole reason, but one of the reasons the sell-off in the S&P and associated NASDAQ and so on was so brutal in 22, because it sold off much harder than, inverted commas, it should have done. Many reasons for that, but this fund or these funds is one of those reasons, and very specifically the feedback loop that arose through dealer hedging dragging the index further and further down through the year.
Right. So, you know, if the index is pushing up against the call, or it's in the neighborhood of the call, you can have this like pinning effect. And you kind of see it on this plot here. So basically, if the stock goes up, the dealer hedges by selling more shares. So that kind of keeps it in more in equilibrium, right? If the stock goes down, they end up buying more shares. So that kind of pushes the price back up. So that's why when you get close to this expiration, you can get this kind of pinning effect at the option strike prices. Now, the puts work a little bit different, right? Since JP Morgan is long puts, the dealers are short puts. That means as the stock drops, the market makers, the dealers, have to short more and more stock. So they're actually, while the stock is falling, to hedge, the market makers have to sell more stock, and that increases the downward pressure on the stock. So when you see a lot of what they call it negative gamma in the market, that's why things get more volatile when you're pushing down on those like put walls. But this is, you can kind of see it's really kind of interesting. So this is just from March 31st right here. You can kind of see it bounced around and kind of like stuck right near that that call strike price. And then, you know, it did pretty well here, and then it kind of hit the put wall here. And, you know, it's not perfect, right? But it's kind of in the center. But whenever the index is close to those option strike prices, it can have somewhat of a gravitational effect. So that's what kind of makes it interesting. And I've been experimenting with selling, you know, iron butterflies and call butterflies around these times, and it basically works. At least I've had good luck with it. Yeah. So that's what's going on. It's this delta gamma hedging, right? So they initially hedge their position using delta, and then gamma tells you how much incremental hedging change there is. It basically, gamma is how much did the delta change with each unit change in the price. So it also gives you this notion of how much additional hedging you have to do if it goes up, or how much additional hedging you have to do if it goes down, right? So it's a call option. Basically, you can get this pinning effect, right? Stock goes up, then the market makers sell. If the stock goes down, then the market makers buy. Okay, a little different dynamic with the put options because they're trading with the market. But again, if it goes down far enough, what happens is, we saw it in 2022, the market makers get fully hedged, and it doesn't really have to go down. You know, if they're fully hedged, they essentially, you know, are completely short. They completely short their position. So that kind of happened with like Facebook, right? They were just completely hedged there. And this is the effect you kind of see. These stock prices don't reflect the SPX. It's something I just typed into a program I wrote. But let's say your strike price is around 140, and if you get closer and closer to expiration, this gamma level just skyrockets, right? So this is kind of telling you the incremental hedging they have to do around this strike price. Okay, great. And then I couldn't retrieve SPX, but I used SPY as a proxy. And this is from March 31st, after the close. And you can kind of see these are call open interest weighted by gamma. And you kind of see it's really high right at that, I don't know what it was, 409 or something level. And so basically, if it moves around this price a little bit, especially since they're calls, if it goes up a little bit, the market makers have to sell a ton of stock. If it goes down, they got to buy a ton of stock. So it really creates this like pinning effect, right? So you can kind of look at, this is the delta level, and then this would just be the open interest. So you can kind of see this is the distribution of all the option contracts, but when you weight it by delta and gamma, it gets more and more concentrated. But this reflects the incremental change in hedging the option market makers would have to take. Okay, so that's about it. I'm past 15 minutes.
Jay, that's fantastic. Thank you. Now, folks, if this is new to anyone here, or the degree of detail is new, then I can tell you from experience that this is a sort of a head explode type of moment. And so if that's where you are, watch the recording again a couple of times and talk to Jay and ask Jay in our chat room. The reason I wanted Jay to come on and do this today is because one of the core things we try and do in the service here is raise everyone's game, and that includes ours, right? I personally, it's Alex speaking, I never stop learning about securities markets, and this service here is one of the places that I learn a lot from many of the members here. And the overwhelming theme that we want to get across in the service is securities markets don't work the way that everyone is told that they work, right? Everybody is told that stock prices are driven by earnings. And, you know, that's peripherally true, I guess. But stock prices are driven a lot more by systemic liquidity, which is to say Federal Reserve monetary policy, than they are by earnings. And index levels are driven a heck of a lot more by the options market than is commonly understood. And within that, this family of JP Morgan funds alone has, you know, an outsized impact, as we've seen. If you look at the slide Jay put up where he lays out the call and put levels that those funds occupied during 22, and you look at, as he said, the gravitational impact of those levels and the fact that the S&P comes pretty near to them around expiry dates, you can see that the securities markets are not simply a game of, you know, is Microsoft earnings going to be good next week? That's kind of third order interesting. Because if the S&P is moving around like this, then it necessarily drags around individual stocks within it. And so what you have here is not at all the conventional teaching. Conventional teaching goes like this. Apple, Microsoft, Tesla, all the big index components report earnings every quarter, and analysts decide roughly what those earnings might be, and people position ahead of earnings, so they're buying or they're selling, and the price levels accordingly, and then earnings are printed and price reacts. So in other words, it's a bottom-up game. And once the price of individual stocks react, the levels of the indices adjust. And that's just backwards. You know, like most things in life, one's motto here should be invert, always invert. And if you invert and you start top down, you say, well, the number one determinant of stock prices is systemic liquidity. The number two determinant of stock prices, at least for the indices, is probably options market activity. And the reason for that is the size of capital flows in options markets today dwarfs the size of capital flows in equity markets. And then thirdly, the thing that affects stocks is probably at that point earnings. And so if you're going to be a successful investor and trader, and this is true for investing as well, right? So you can't just go, well, I'm a long-term investor, none of this stuff matters. It really does matter. You know, in our work, we publish these Wyckoff rotation cycles, and you see that over many years, you know, a Microsoft and Apple will have a run up, a run down, a run up, a run down, and so on. And those things are, you know, track them. You cannot predict those moves through earnings alone. You have to understand systemic liquidity flows and option market behavior. And this family of JPM funds is a sort of crystallization of that point. And this was this was new to me in 2022, because some of the work I was doing was trying to figure out, well, why is the market this bad? It shouldn't be. By any conventional theory, it shouldn't be this bad. And this led me here. So we'll do more work on this over time in the service. It doesn't matter whether you trade options or not, trade futures or not. This is essential stuff that you have to know if you're going to be a successful investor and trader. You have to know what is it that's dragging around the indices, and therefore what is it that's dragging around the price of the stocks that you want to buy or sell. And only then, when you've got a much better picture, can you make good decisions about buying or selling. So Jay, thanks so much for coming on to do this. Jay, a few weeks back, a couple of months back, actually did another webinar for us that was a sort of an options basics. That's in the webinar recordings list if you want to go there and retrieve it. Presentation today was excellent. It does take a bit of understanding this if it's new to you, so do watch the replay. I just want to show you as well, I'm going to take back presenting right here. I just want to show you how to find Jay's work in the service as well. Just 1 second. Okay, so here we go. So this is Seeking Alpha Chat. And if you find the chat channel that's called Growth Investor Pro Jay's Options, it's here. And every morning, every single morning before the open, Jay posts a number of tables and charts, and he'll tell you what his work is saying about where the near-term resistance levels are in each of the indices and the near-term support levels. And he calculates that by a function of options market behavior, and specifically dealer hedging. No system is perfect, and so these numbers are sometimes prove correct, sometimes don't, but they're pretty good. And again, whether you are short-term trading, definitely use this channel. But even if you're long-term investing, you need to know where in that rotation cycle the stocks or the indices that you own are. And these charts can help you work that out. So it's difficult, it looks challenging, looks like it makes your head hurt. It's really, really worth putting the time in to learn. So thanks so much, Jay. It's a great presentation. Again, folks, I would encourage everybody to look at the Jay's Options channel. Even if options aren't your thing, doesn't matter. This is must understand stuff. Okay.
I just want one thing. I'm really open. By the way, I'm really open to ideas. So don't be shy. You know. Okay. Thank you.
Thanks again, Jay. Okay. Questions. Andrew, you have your hand up. I'm going to unmute you. You're
there
on.
We go. Am I on?
You're on.
Okay. My main question is I would really love to get deeply into what Jay's doing, because I mean, by showing the size of those JP Morgan funds and what you said about you said these funds had a overly dramatic impact on what happened in 2022. It seems like I really need to get up to speed on this. I'm a real newbie with options. Does Jay, or can you recommend a options primer starter page or a book or resource, or do you have one? I mean, I'd rather hear it from you, but if you don't have one, can you recommend one?
I can post some links.
That would be great.
There's something called the Option Industry Council, OIC. They have a number of webinars, and they're all free, and they're technically very sound. Yeah, it's free. I mean, I've paid to attend, some option things, and they're not as good. Also, some of the Tasty Trade has got a options crash course by a guy named Dr. Jim. He skips over certain things, and Tasty Trade has a certain philosophy of how they trade. So it doesn't give you, they really don't do speculative option trading. They do more premium, they sell premium kind of options, which is mostly what I do as well. But different people have different takes. So I'll post a couple links, but I found both of their presentations and their course very helpful. And there's a number of books. Just getting a good basic. I'll put a link to just a good basic book. Everybody learns a little bit different.
What was that first? You said Option Industry something.
Yeah, it's called OIC.
Option
Industry Council.
Okay.
Yeah.
Oh, I see.
And basically, they're funded by the option trading clearinghouse that clears all these transactions going on and stuff like that. But they've got really good presentations.
Great.
Thanks, Jay. Anyone else have any questions, folks?
Thanks, Jay.
Oh, very well.
Thanks, Alex.
Good question, Andrew. Thank you. Okay, everyone's heads exploded. Jay, thank you. I'm going to move on to something much more boring and pedestrian, which is to say the equity indices, which we all know are just a derivative of something else rather than actual securities by themselves. But let's just run on. And as we head into this long weekend, so markets, equity markets are closed tomorrow, Friday, reopen on Monday in the US at least. Yeah, you think European markets are closed Monday. Let's just see where we stand in the various indices. So if you were in chat today, you'll have seen that personally I reduced a fair bit of risk going into the weekend just because there's payrolls data tomorrow, which is unusual to be happening on a non-trading day and long weekend generally. So why not take some risk off the table? Okay, so let's take a look at the indices. So I want to run through longer term and shorter term. Let's do the S&P first. I'm just going to switch off this volume chart. Okay. So two ways to look at this. I think you can say, well, the S&P bottomed in October and we're in a wave 5 up now. This technical pattern, this Elliott wave 5-wave pattern, has held really well since 2016 in the S&P. The retracements, wave 2 down, 78.6 down, wave 3 up, 1.618 up, wave 4 down, 0.5 down. That's picture perfect. I mean, you could teach, chart school with that. And so if that continues to hold, then we should see a wave 5 up that reaches, at the very least, 481 to make a new all-time high over that wave 3 high, and more likely makes it to 533, maybe makes it to 583 before it turns down. So if you were to look at the likely terminal range, if you believe this chart pattern, and if you said, the lowest high that wave 5 should make is, let's call it 482, and the highest reasonably is 583. Of course, it could go higher, but let's call it 583. Best guess for me, 530, maybe 540 before a downturn. That's one way you can look at it. The other way you can look at it is you'd say, well, that's all very interesting, but that hasn't happened yet. And what we actually have right now is basically just some sideways action. And so you could say since May of 22, we've just had sideways action. We had a spike down, sure, in June, and a spike down towards the end of 22. But really, as we can look at here, they weren't particularly high volume spikes. If we start the volume clock at the all-time high right there, you can see that the amount of selling down here was pretty small, right? So this is retail panicking, momentum hedge funds getting margin called, but this is not big money sales down here. This is accumulation right here in the sideways box. So another way to look at the S&P is it's just been range bound since May. And again, we all think that 22 was a rough year, that it was terrible all year. Well, yeah, it wasn't. It was sideways since May. So we're now in almost a year of just sideways range bound action in the S&P. You can forget the August high, you can forget the June or the end of Q4 spike down. These are nothing burgers. They look dramatic, but the volumes are low. Really, this is accumulation here. Now, if you push me, my own opinion on this would be, well, all that's happened here is that big money took some gains off the table at the highs up here, waited for it to come down, and is now building a new price base in this new world environment. The new world environment is more protectionist than was the case pre-pandemic. It was drifting that way anyway, but the pandemic's accelerated that. We are in a higher inflation, higher rate environment. I don't think anyone thinks that the rates are going back to zero anytime soon, or that inflation's going back to 2% or below anytime soon. Rates may fall a touch, of course, but we're not going back to the zero rate regime anytime soon. So I would view this as institutions rebasing their S&P capital in this new environment. And this is one of the reasons I would expect to see a move up soon, a sort of breakout of this box, which is to say, at some point they will have accumulated enough S&P positions be that in the ETF here or futures or options, whatever it might be, for them then to spur a move up and have late buyers come in. That's momentum funds who will buy high, sell higher, perfectly sensible discipline if you're good at it, and then ultimately retail. And you can expect a retail rush at 480 plus, when the new all-time high is struck. So that's the S&P. And if we're going to dive in shorter term on the S&P, we use the futures to do that because there's more trading data. Futures, as you know, trade almost around the clock. They don't trade on Saturdays, but they do trade round the clock in Asian hours, and late Sundays the globalization session opens. And here's what the S&P looks like in futures form on the shorter term. So this is a 4-hour chart, and this is the October low down here. And again, the Elliott wave pattern works out quite nicely. So we get a 1, 2, 3, 4, 5 wave up to middle of December. So on the futures, 3,500 up to about 4,200, and you can very, very roughly divide by 10 to get the SPY ETF level roughly. We then get a sell-off, wave 2 down into the end of year December lows, and then we start this wave, large degree wave 3 that we're in now, that started at the end of December, and we're still in, and we've put in a wave 1, a 2, and we're in the wave 3 of 3 now, which is why the move up in the indices feels so unstoppable. We're in a wave 3 of 3, so that's the most powerful up wave you'll find. I would expect the S&P to keep moving up, maybe a little bit of a breather after this weekend once macro data is digested, but even after a little sell-off, I would expect this to keep moving up. So that's the S&P. Let's do the Nasdaq, same basis. You could think of the Nasdaq, to be honest, as a more volatile derivative of the S&P. So it moves approximately the same time frames, but it moves up more and down more. So again, you could use the QQQ. This is the ETF, but the index chart looks the same, the options chart looks the same, the futures chart looks the same. You could teach this in chart school, right? So from the 2018 lows, last time monetary policy went from tightening in 2018 to loosening in 2019. You get a 1 up, a 2 down, 78.6 retrace, a 3 up, 2.618 extension on the way up, a 4 down, retrace seems to have gone missing, and that 4 down is a 0.618 retrace, almost to the dollar, tested all the way from October through to January, holds firm. And then again, we're in a wave 5 up now. I think the impetus, the move up in the Nasdaq looks more dramatic than the S&P, because you could say the Nasdaq was sideways between, say, September and February in this sort of 258 to 286 zone here. But really, it to me looks like we have started a sort of a channel up that looks something like this, and it's moving up this wave 5. We'll see, but that's how it looks. So again, if you look at the Nasdaq's recent moves, if we zoom in, you'll see that looks like we're at a wave 5 high right now in the smaller degree. So we'll probably, I think, get some weakness after the weekend, which is why you saw me taking out hedge positions. But again, over the course of the next weeks and months, year, I would expect it to move up. Let's look at the Nasdaq in the smaller degree. So this is again the NQ futures and 4-hour chart, and just take a look at this. This is a really important chart. So this is back to the January lows. We get this wave 1 up, 2 down, which is about a 0.5 retrace, quite a shallow wave 2, wave 3 up, big wave 3 up, peaks somewhere between the 2.618 and 3.236 extension, 4 down, a 61.8 retrace down, which very interestingly, the theory of these waves is if you get a shallow wave 2, you get a deep wave 4. That's what we saw here. And then a wave 5 up. Now, wave 5s typically peak somewhere between the 61.8 and the 78.6 extension of waves 1 and 3 combined. So you take the price move from the low the 0 point to the high of the wave 3, and you multiply that by 0.618, 0.786, and you place that at that wave 4 low. And this is the green ladder here, this extension ladder. So that's telling you that, well, the peak that the NASDAQ hit this Tuesday is smack bang in the middle of the 61.8 and the 78.6 extensions of wave 1 and 3, and that's why we've been flagging every day that's a possible high. Now, it could go higher for sure. We could see a move up in this wave 5. It could hit 13,500 on the futures. It could do, but even if it does, we will, I think, then see a downturn, and the turn down after a wave 5 can be pretty dramatic. So it can give up all of the wave 5 move up. So even if we see NASDAQ went up to the 13,500 level, we could see a downturn to the low 12,000s, even the high 11,000s. Now, we're talking about different time frames here. So we stand by this view, this longer term view that says, you know, sometime next year, we're probably going to get a new all-time high in the NASDAQ. But short term, probably some weakness first. Let's do the next two indices, and then we'll stop for questions before we come on to Woodstock. So let's just briefly do the Dow. It's the same story, really. The Dow and the Russell are in slightly different points in their cycle than the S&P and the NASDAQ. So the Dow rocketed out of the lows faster than anything else. You can see it moved up like a scalding cat from the October lows, 286 on the DIA ETF, up to 348 in no time at all. The high in December from the low in October. And since then, it's just drifted down, started to move back up again now. So the NASDAQ looks very, very extended on the short-term chart, as you can see. The Dow, that's not the case. So the Dow looks like we're probably around a wave 3 high on this time frame. And so personally, I sold my Dow holdings today for a modest gain, nothing dramatic, but just took some money to the bank. And that's because the Dow very often doesn't make dramatic moves up. So where in the S&P you might see a 1.618 extension for wave 3, and the NASDAQ you might see a 2.618. The Dow 1.236. That's about right for a wave 3 high. So I'd expect a little bit of weakness now, nothing dramatic, I don't think, before another move higher. So again, let's start to see that digest over the long weekend. And then finally, the Russell. Russell's a really interesting index right now, I think. It's everywhere written off, right? Everywhere you'll see people saying it's a disaster area, it's weak, blah, blah, blah. But I think it's under accumulation. I think that big money just hasn't bought enough of it yet. And so I think that since June last year, in fact, longer, May last year, again, there you go, we've been range bound on the IWM ETF between about 190 and about 170, let's call it. And I think we're going to just bounce around in this box for some time. So this is very tradable, as you can see. If you buy the bottom of this box and sell the top of this box, that's just free money, all day long. I think at some point this will stop accumulating, and again we'll get stories about how exciting small caps are this year because of blah blah blah, some reason or other. And I think we'll see that start to move up, and you'll see momentum funds come in, and you'll see retail come in due course. Again, probably when we reach or get beyond new highs. So I've not put a wave chart on this. I think this is a much more interesting way to look at it right now. But if we just zoom in and look at the Russell futures on the shorter term, again, this is a really neat chart. These surprising how well these waves and fib charts work. So this is the Russell. We're looking back to the December lows here. We get a wave 1 up, a 2 down to 78.6 retrace, 3 up, peaking just above the 2.236 extension, a 4 down, 0.5 retrace. You see how well these things work, right? And then a really big wave 5 up here in early February, which reached the 100% extension of the wave 1 and 3 combined. That's a huge wave 5. And then, unsurprisingly, we then see a big sell-off. So this green wave here, that's a larger degree wave 1, and then we get this larger degree wave 2, this red line all the way down here, which in fact gave up more value than had been created since December. This is a big sell-off. We then started, as you'll see, and every morning we've been flagging this. This wave one up starts around the 24th of March, and we called this week. We said that's probably now turning down into this wave two. So on the Russell futures, we may see it drop a little bit further yet to around 1730 on the futures. That'd be the 78.6 retrace of this one up, and then I would expect to see a move up. And then again, if you go back to the larger degree, I'd expect for now resistance would be found at the IWM 190, let's say, level, the futures equivalent. So for now, if you want to make money from the Russell, just consider buying bottom of this box and selling the top of this box, and you do that, every few weeks. At some point, it will break out, probably to the upside, in my opinion. So be ready if that happens. Don't get caught short. But that's how I would see the Russell. Okay, we're going to move on to scary tech wood stocks in a moment. But before we do, anyone have any questions or points, anything at all to raise? Everyone's unmuted my side. So if you do, good time to share.
Alex, this is Scott.
Hey.
All right, I'm trying to bridge the information that Jay provided with what you provided, specifically on the support and resistance lines. So I sort of have really one question, but two parts. The first part, I look at your daily updates every day and I write down the support and resistance line for the NASDAQ and the SPY. Now, I assume there's a direct connection between what you write and what Jay writes in his post on your site for support and resistance lines. Is it the same or direct or no correlation?
They're produced independently. So what I would say is if the lines correlate, that's very strong, right? So we come at it through completely different methods. And if I'm honest, I don't cross-check them. Jay does really good work. I'm very confident in it. I don't check what he's publishing every day. Most days I read it, but I certainly don't see it before he publishes it. And he comes at it from a completely different method to myself. And so what I would say is, nobody's levels are perfect ever, of course. Both methods seem to work reasonably well. And what I would say is if you get a confluence of levels, I have a very high level of confidence in that then. If you've got, pure equity technical analysis and options market analysis, they're telling you the same things, that's a really strong message. If they're wildly different, then you probably say someone's wildly wrong, and it's hard to say who. And if they're sort of roughly the same, okay, that's probably good enough. Okay,
so the second part and the real question is, I write them down every day, but I don't know what to do with it. Is it anything, so I'm saying, why am I writing them down? But I want to know, is it something actionable I can do once with these numbers? I see how they move like on your charts a little bit every day, but all I do is write them down. How do I make that actionable information?
I'll tell you what I do. This is because everyone who studies stock markets is a little bit OCD, right? I'll tell you what I do. Okay, so I use the let's go on to the NASDAQ. Okay, I use the larger degree charts to set course for longer term investments. So when I look at this NASDAQ chart here, what I'm thinking is, okay, in probably a year, I mean, they're not so great on the timing accuracy of these things, but let me put it the other way. When the NASDAQ's getting towards the 400s, I'm thinking that I'm going to be selling quite a lot of my growth holdings and looking for something to rotate that capital into. I'm mentally prepared for that, and I'm not particularly selling them right now, although I did sell Nvidia just now just to pocket some gains. But I'm thinking, okay, get ready and have in your mind that if you see the NASDAQ getting anywhere near the 400s on the QQQ, you need to be thinking about taking some gains. And that's because personally I run closed-ended accounts, which I do just because I grew up in leveraged buyout funds. They're closed-ended funds, and that's just my DNA and training. It's what I'm used to. There's nothing good or bad about it. It's just what I'm used to doing. I'd be looking to liquidate those growth names as that NASDAQ reaches a peak. Equally, when we were starting to bump along this wave for low, if you go back to the service disclosure alerts, you would have seen, numerous buys down there. So in particular, speaking of my long-term account, when Maxar was acquired, that generated some good gains into that fund, and I redeployed that into high growth stocks that were bumping along the bottom here. So I use this chart personally for longer term investing. I use it to work out roughly when to buy these things and when to sell. Then you've got to do individual stock analysis, of course, but just that's the backdrop. Shorter term charts. So I'm going to look at let's look at the Qs again here. But I use this for those ETF trades, right? So, the reason for my nervousness over holding NASDAQ unhedged long at the moment is because it looks to me like we're at a local wave 5 high. And sure, it could run higher. We could see that not top out till the 13,500s. It could, in theory, run up to 14,000 before turning down, but it probably won't. So I'm reluctant to have unhedged long up here. And so I'd rather try and find some ways to profit from the downturn. SQQQ was my single best performing holding last year, no surprise. It's a really powerful instrument used correctly. And so I just like to use the SQQQ to try and catch some gains on the way down, because what I'm trying to not do is sell any TQQQ, because why would I, right? If the NASDAQ is truly going to do this, then TQQQ ought to be my best holding this year. So I at the moment, don't ever want to take profits on it. I don't want to trim it. I just want to hold it and have it keep compounding up. But if I'm going to do that, that means that I want to use SQQQ on the down moves. And so I use these shorter term charts to work out, okay, where are we in the short term moves? And again, it's never perfect, but they're not bad, these. And I use those to drive those short term ETF trades. That's what I use them for.
Okay, I got that, but I was asking specifically about the support and resistance line. When I write, do they have any meaning to you when it changes every day?
Which ones?
On your charts, on your long term and short term, you have support resistance line on all your charts every day. Well,
I have the fib ladders. Okay, so what I'm doing with those is they're not. I mean, you can see that sometimes they do act as, so here, if you look on the NASDAQ here, you can see that 38.2 extension right here, that did act as support really nicely. You can see the 0.5 extension held as resistance really nice. So they do that. But what I'm using them more as is a yardstick, a ruler. So what I'm really doing is saying, well, from this wave 4 low, once it looks like we're in a 5 high, how far is this going to go before it turns down? So, if you think you're in a wave 5 high, it's probably not going to turn down in the 12,600s because you haven't made a new high yet. Once you start to get over that wave 3 high, then you start to get a bit nervous. If you were to touch the 78.6 extension, you get very nervous if you're not hedged. So I don't treat these as support and resistance lines. I treat them as measurements, which is to say, how extended are we to the upside and how depressed are we to the downside? That's what I use them for. They do happen to sometimes act as support and resistance because, traders use these things as standard tools. But I use them as measurements.
Okay, thank you. That's very helpful.
What I do is most days I'll then look at Jay's work. And in particular, what I look at is what's the movement in the call walls and the put walls and then the index I'm in. So I'll look at, for instance, the NASDAQ, and his post every morning will say, well, the call wall is here. It was here yesterday. So the call wall's moved up, right? And that's obviously broadly bullish because it's saying that there is some slack to the upside. And if he says, well, here's where the put wall was yesterday, and here's where the put wall is today, if that's moved down, that's bearish because it's telling you that the support level provided by dealer hedging is just that bit lower. And so my method is, I use these charts which I produce. I'll then go and look at Jay's work, not every day, but most days, and I'll say, okay, does that roughly tally? It doesn't have to be perfect for me, but if the two methods are wildly out of sync, then I'll think, okay, well, one of these is wrong, right? And therefore, my conclusion is I haven't got time to work out which is wrong, because I know that Jay has done good methodical work. I know that I have. And if the two methods don't tally, it just tells me that I can't have too much confidence in what's going on, and therefore either don't do anything or hedge, right? So that's my method, and probably not very scientific, but it sort of works.
Okay, so I think my mistake, that like in this chart, I thought 13,163 was a support resistance level, but it's just one of your fib levels.
Yeah, I mean, I don't know what theory is on this, because this is sort of self-taught, to be honest. But the way I use these is very simply, I use the waves as the wave count is, you know, are we in basically a bullish or a bearish phase on whichever time frame it might be, and I use the fib retrace the downward moves and the extensions of the upward moves to measure emotion. Basically, it's a way of measuring opinions or misery. And because, you know, large account market participants use this language, it works pretty well. It's not perfect, obviously, but it works pretty well. So I use it as measurement.
Thank you very much.
Okay. Anyone else, folks? Okay. We're almost out of time, but before we finish up, I want to talk about a few so-called Woodstocks. So what I mean by that, you know, it's usually an insulting term, is the high beta software stocks that made huge bank in 2020 and 21, sold off hard in 22. Jay, I'm just going to mute you if that's okay. Sold off hard in 22, and have become, you know, forgotten and written off as, you know, terrible companies, terrible stocks. Everyone's a bag holder, blah blah blah. But many of these, some of these, have, you know, left the station and they're on the way. So HubSpot, there was some discussion in chat earlier. HubSpot's a great point. CRM software company, huge run up, as you can see, from the COVID lows to the 2021 highs. Big sell off. This 78.6 retrace, by the way, this is like 20-30 stocks have done exactly this. Okay, quite incredible. So big move up here, 78.6 retrace on the way down, and then held as rock hard support since July in HubSpot. So again, you know, the bottom was in the market in Q2 for most of these names last year, not in Q4, but in Q2. And since then, HubSpot has, you know, off the races, and it's up into our markup zone. It's hold rated right now, and so the opportunity to buy that at the lows is clearly gone. These retrace and bounces, you know, the most fantastic ones were Meta Platforms. So I diversify a little bit, digress a little bit here, but Meta Platforms, and of course Nvidia. Now, I failed to be smart enough to buy any Meta at the low, but I did help myself to some Nvidia at the lows, and that's been pretty remarkable. And again, look at this 78.6 here. So this is from the 2019 lows, rocket ship on the way up to the 2021 highs, 78.6 retrace on the way down, almost touches it, spike down here in October, and then bang, off to the races. Now, the interesting thing for me is, let's look at the stocks where that has yet to happen, where they've yet to make that scalded cat bounce. Let's look at Datadog. Okay, here's Datadog from the 2019 lows to the 2021 highs. And again, look at this sell-off down to the 78.6 retrace. It touched it almost in December. And it's just, this is a weekly chart, and it's just proved rock solid support since then. So that's around 65 bucks a share. And so, of course, it might be that this thing is just going to keep going down. It could do. But because it's at that 78.6 retrace, you can place a stop not too far below this, so that, first of all, if it plunges through the 78.6, then something, you know, bad has happened to the company or the market. But equally, the risk reward here is fantastic, because if you can put your stop a few dollars a share below here, so if it does trigger, you haven't blown too big a hole in your account, but your upside genuinely is to a new all-time high. You have to wait for that, but is truly to a new all-time high. If you're less patient than that, then you can always just simply trade between the two fib levels. Buy at the 78.6, sell at the 61.8. Buy at 65, sell at 92, and do that all day long while it's in this accumulation zone. So that's Datadog. And there's a number of others. Let's just run through a couple of others. Dynatrace left the station. Cloudflare, just about still in the station. Okay, yeah, just about. Same story. Huge run up, sells off hard. Actually goes down a bit, but it's sold off harder. And that's probably because Cloudflare has been heavily cash negative, whereas people like Datadog cash positive. So this is deemed much a riskier stock. But nonetheless, has exhibited this sideways action. Started to move up and out. It's poked into the markup zone briefly, come back down again. So there's again opportunity to buy Cloudflare here at the lows still. Let's see who else. Roblox, same story. This is charted from a notional zero, but from a zero up to the all-time high. Drops down again. Look, that 78.6 is meaningful, not to the dollar, but it was down there in May. Again, this thing May keeps recurring. Moves up to 61.8, finds resistance, bounces down, support around the 78.6, and up again. So when these stocks are range bound in this accumulation zone, you've got a couple of opportunities. You either, buy at the lower end of the zone and sell at the upper end, and just do that whenever the opportunity presents itself, or buy at these lows and hold to see if they can in fact move up to this markup zone. Personally, with Nvidia, I sold it today from memory. My view was, I don't need to hold it and see if a new high happens, because it's moved up so quickly that I can take some gains now. Thanks very much. That looks like, just visually, looks like a wave 3 high, right? 1 up, 2 down, 3 up. And if so, it's going to sell off some before moving up again. And so that means that I have a pretty good opportunity to buy back in at some point in this markup zone, I suspect. And if I haven't and it runs away, okay, fine. There's always something else to go and buy. But probably this will run down and give another opportunity. And so, again, there's many ways to use these charts, and I'd encourage everybody to think about how to use them in your own work. The point of this service isn't to tell people what to do. It's your money. You know better than we do, or we could ever hope to. The idea here is give people the tools and methods, tell you what we're doing in our own accounts, and help you with your own work. Let's find one more of these. Yes, Snow software. Okay, so this is Snowflake, another great example. So the chart here starts at notional 0, big spike up to the all-time high really early, just after the IPO. It actually peaked in 2020, sold off, sold off, sold off, sold off. June last year finds a low at 110, and then since then it's been sort of sideways, and it's still in this accumulation zone for now here. So personally, I've not owned, I don't think I've owned Snow at all until recently. Maybe I traded it briefly, I can't remember. I don't think, I certainly haven't owned a long-term position at all. And I've started to pick up a couple of shares this week, because I figure, okay, well, I'm going to buy it in tiny, tiny, tiny bite sizes. So if it drops down again, just add some more in this accumulation zone. But if it runs up, I can start to enjoy gains, even if it is on a relatively small allocation to begin with. So what I would say is these stocks are high risk, and to the point about levered beta in chat today, that probably doesn't make sense to blow your life savings on, but pay close attention, because there's a good chance that these Wood stocks, and in fact the Cathie Wood funds themselves, start to move up, because as the rate hike cycle eases, whether rates are actually reduced or they just flatten out, the flood of liquidity that's come in with the bank crisis means that these high beta stocks and funds are going to be of more appeal than people think. And I think they're going to take people by surprise to the upside. The final chart for you, this is the ARK Innovation Fund, ARKK, much maligned. Everyone's laughing at it, right, which is a great time to go and buy something. Everyone thinks Cathie Wood's an idiot. As a fund manager, I tell you she's a genius, because she's printing management fee all day long. And look where it is, from a notional 0 up to the all-time high, bounces down, 78.6 retrace yet again. And look, it's been there since May, again, May. So there's nearly a year of accumulation of these things. And I don't have the data here, but someone did some very good work showing that the institutional ownership of this fund, this ETF, is high. I think I'm right in saying that Fidelity or someone owned about 13% of, anyway, a surprisingly high number, percentage of an ETF. Just look at the volume down here, right? So this volume is since the all-time high. No volume, no volume, no volume, no volume. Bang! Once you get to 78.6 level, this huge volume spike between $44 a share on the upside and around $34 a share on the downside. So that accumulation, it's unlikely to prove fruitless. It's probably going to move up, and when it does, nobody will believe it, right? It will be laughed at. World will have gone crazy. This is just, you know, Zert boys playing again, nonsense. But that's probably going to move up. So again, these aren't names to YOLO by any stretch of the imagination, but they're not names to ignore, I think. So do your own work, decide if you're up for the risk. If you are, think about where to place stops, think about risk management techniques, position size, patience, stops, all of that. But don't be surprised if these names start moving up, because many of them already have. You know, NVIDIA fundamentals are dreadful, truly awful. Things going backwards, margins are going down, balance sheets getting weaker, the stock moved. You know, again, as we said at the start of this session, it's not earnings that drive stocks. Earnings are an interesting thing off to the side. Other things drive stocks. Liquidity flows, options markets, they drive stocks more than earnings. Okay, we need to finish shortly, but any last questions or points that anyone has? I did see James get a hand up. Let me just unmute you. There you go. Okay, go for it. James, can you unmute yourself? Just right-click that mic and unmute. Okay, we can't hear you. Can you type the question in the chat room? You have access to it? Okay, still can't hear you. Okay, I'll tell you what. If you can, put the question in the chat room later on, and we can deal with it that way. Okay, anyone else got any points, folks, before we finish up for the day? Okay, in that case, we'll call it a day. Thanks, everyone, as always, for your membership here. Service is going from strength to strength. We had an incredibly good 2022, which is just remarkable given how the market was. We continue to grow really strongly through 23. Incredibly grateful to Jay for the great work he does in the service and superb presentation today. Thanks, Jay. And thanks to all of you being members here. Post a recording for this in a couple of hours' time, and we'll see you in chat later today and no doubt over the weekend as well. And we'll speak soon. Thanks a lot, folks.